Hi, do you play chess? If you do, have you ever played against a computer? Now, why would I mention chess in a channel dedicated to sleuth investing? For two reasons. First, as you will see in my book, The Advanced Sleuth Investor, there's a chapter that compares investing to playing chess against a computer. But second, in that same chapter, the comparison yields a nifty formula to evaluate a company quality, which, like a chess computer comparing different board positions, would enable you to compare the many thousands of stocks in the market and decide which one deserves your attention enough to dedicate time to sleuthing it. But why do I mention this today? Because today I want to talk about stock spin-offs. When I used to run money, I used to love them. Now, what's a spin-off? It's a former division of a corporation which the parent has spun off as an independent, newly public company. The way it's usually done, every shareholder of the parent gets share in the spin-off in proportion to his or her holdings. So why did I love spin-offs so much? For at least three viable reasons. First, managers of the newly freed company are finally liberated. They have shares or options in their own operations, not the parent, so the incentive to work harder are bigger because they can get richer faster. Second, they can even go after customers of the parent or develop new products to compete with it. But third, institutional investors, the slow turtles in the stock market, often twiddle their thumbs before they decide to buy more of the spin-off or sell it. So there's an opportunity for the fast thinkers. So if you act fast enough and buy a spin-off, you're good? Not always, no. Because spin-off's potential is, first of all, widely recognized, and secondly, also varies from one to the other. Joel Greenblatt, founder of Gotham Capital, who is also mentioned in my book, just loves spin-offs. So does Seth Klarman of Baupost Capital, a highly respected value investor, as does Charlie Munger of Berkshire. All recommend studying spin-offs for the profit potential. So the idea is the new one. However, before I go further, I must point out to you the exact words of Charlie Munger, Buffett's partner. He said, carefully study spin-offs. Why carefully? Because, as I said, not all spin-offs are the same. Some are more worthwhile than others, while others are mediocre at best. So if the spin-off is mediocre, it may well be undervalued at the time it's spun off. But then the only gain you'll get from it is a one-time bump of the stock price rising to proper valuation. Afterwards, however, the stock will only rise based on its intrinsic quality. The trick then is when a spin-off is announced, study it, yes, but don't buy blindly before deciding whether the new company's quality deserves becoming a part of your long-term portfolio. But decide how. Yes, by sleuthing it physically, as per my book. However, sleuthing is time-consuming, so as not to waste time on every spin-off, you should have an initial screen on what deserves your sleuthing and time and what doesn't. How to perform the screen? Here is an example, is one recent spin-off, an actual spin-off, and a quick review of the process of deciding whether it deserves your attention and time or not. The company in question is Master Brands, MBC symbol. Master Brands makes and sells residential cabinets for kitchens, bathrooms, and other home parts, and sells through Home Depot and Lowe's. On December 2022, only 3 months ago, it was spun off from its parent, Fortune Brands Innovations, symbol FBIN. Fortune Brands has been a great stock, rising 7 times in the last 13 years, much more than the market during that same period. The question is, can Master Brands, as a spin-off, do something similar as its parent? It is here that the first cut estimation is called for by answering the question, what is the quality of MBC, the spin-off, compared to the quality of its parent? I already mentioned the company's quality before, which I call Q. I note it in my book, but just to recap. In my book, there is a chapter dedicated to chess comparison to investing. A chess computer must decide which of a huge number of potential chess moves deserves deeper analysis. Just like you, an investor in the market, must decide which stock deserves your time and attention right now. A chess computer does this by summing up different categories for each board position, equivalent to a stock, to arrive at an evaluating function. The same method is often used by stock sleuths to decide which stock is interesting enough to sleuth. The equivalent evaluating function for investing is called Q for quality, and like a chess evaluating function, is composed of a number of parameters. To be specific, Q is defined as the sum of gross margins, return on equity, and sales growth. In the case of MBC, the recent spin-off, Q comes up as 23, below average, due both to low ROE and low margins. However, the value of the spin-off, which I call V, is the Q divided by the ratio of EV to EBITDA, which here is a dirt cheap 3.8. So V, the ratio, comes up at a very cheap 6. In other words, MBC corporate spin-off is of low to moderate quality, but its stock is selling now very cheaply on the initial numbers. What would raise the corporate quality higher for the spin-off? Either gross margins would have to rise, that is, cost would have to cut, or return on equity would have to rise, that is, earnings would rise without requiring more capital, or of course, sales growth would have to accelerate. Is any of this likely? Right off the bat, I would say it doesn't seem very probable, but it is possible. But if you are interested enough to find out which, start sleuthing the company. Establish a connection with the low and mid-level people at the spin-off and find out what they think. Don't just use logic. Look for facts from reality, real facts, physical ones. Finally, what about the parent, Fortune Brands? How does it stack up? Well, there the gross margins are 17%, double that of the spun-off subsidiary. Its return on equity is 21%, or 2.5 times that of the sub, while sales growth is about the same or lower. So the parent's quality is 38, or 1.5 times that of the departed subsidiary. Its EV to EBITDA, however, is 10, for a V value of 3.8, about half that of the spin-off. To sum up, the parent has a better quality operation than the subsidiary, but it is valued a bit more expensively. It's clear now why the parent let MBC go. MBC reduced the parent's own ROE and gross margins, so letting it go would raise the parent's own quality. The sleuthing question now is, can the spun-off MBC climb up to the levels of the parent's gross margin and return on equity, so as to raise its own quality, and so replicate the parent's performance too, maybe? That, of course, is what your sleuthing would aim to find out. If the answer comes out as a no, then MBC spin-off could provide at most a one-time bump. If, however, it comes up as a yes, then MBC spin-off may perhaps provide good long-term performance too, same as its now separate parent. Which is it? You got it. It's up to you to find out by sleuthing the MBC spin-off physically yourself. That's all for now. If you like the above clip, please subscribe and retweet to your friends and followers so they subscribe too. Then please buy my book, The Advanced Sleuth Investor, and write a review about it for Amazon, which I hope is a good one. I'll see you next time, and meantime, thank you very much for watching.